The Fed may be about to get more aggressive with interest rates. Steve Liesman joins us right now with more. And Steve, the conventional wisdom at this point is that they're going to hike by 75 basis points, not by 50 tomorrow.
Yeah, Becky, the Fed very likely at this point to announce a 75 basis point increase at the conclusion of the two-day meeting that comes on Wednesday. My reporting finds the Fed is likely to accelerate the pace of rate hikes from the previously expected 50 basis points in response to higher than expected inflation and rising inflation expectations. What happened? Well, the CPI accelerated in May to a new 40-year high. The New York Fed's one-year inflation expectations reported yesterday surged to 6.6%. That was a new high for the series. And the University of Michigan last week reported the five-year inflation expectations. That's the one the Fed really watches, were the highest since 2008. The move, if it happens by the Fed, would seem to be another about face for Fed Chair Jay Powell, who said at his last press conference the Fed was not, quote, actively considering a 75 basis point hike, but he did say his statement was conditional on the economic outlook evolving in line with his expectations, including for inflation to gradually flatten and decline. Well, the 75 basis point hike is a clear signal that is not happening. Markets think this will amount to not just faster, but more rate hikes overall, and it sharply repriced the rate outlook. Take a look at the Fed funds futures market and how it's priced, currently around 90 basis points. You can see there in each month, the key month that we pointed out here, the terminal rate now is almost 75 basis points higher. So the market is not just going 75 now, but it's adding another 75 basis points over the cycle here of hiking here, including at the very end there, 361. You can see that decline is now priced in to the market here. Faster rate hikes have consequences, creating economic pain that echoes on Main Street and Wall Street. There's not universal support for this move among Fed watchers. Krishna Guha from Evercore ISI writing, this is not what we anticipated, not what we think is optimal policy, and separately, not, in our view, good for markets. The Fed may also believe there is more inflation to come from wage hikes and the Russian invasion, and now believes inflation is much less likely to take care of itself through supply chain easing. Becky?
Okay, so Jay Powell has always wanted to communicate clearly with the markets so that they're not caught off guard, so they're not surprised, so there's not a huge sell-off in stocks, just a knee-jerk reaction of not knowing. That's kind of been Fed policy for a while, is to guide the markets as to what's coming. I get it if the numbers have come in stronger than they anticipated, if inflation now looks like it's not going to take care of itself, and they're admitting that inflation hasn't peaked at this point. But why continue to kind of spoon feed the markets this? Like, why not do a shock and awe? Why tell anybody anything? Because the sell-off's already been here. We've already seen a huge drop in stocks the last 3 trading sessions. Why not just do shock and awe and surprise us with this tomorrow?
I think to give markets some preparation for it, Becky, remember, it's really important that Treasury markets work. And I've not heard some great stories about it. I haven't had a chance to report totally what's going on in Treasury markets. But, you know, what you've seen, for example, in the rise of the 2-year, that creates tremendous economic dislocation. I would think, Becky, that the question is, why not do 50 tomorrow, meet market expectations, and essentially telegraph a 75 at the next meeting? I'm not sure how much it matters to surprise markets. Markets are on board with this idea that rates have to go up and go up quickly. I think the real question here is, guys, if you could put up that 2-line chart we just had up there, is that terminal rate and how much the Fed wants to bring forward in terms of hiking. That's now 3.97, 4%. You'll remember for the past several weeks now, I've been talking about a 4 or 5% funds rate, at least for a time. Whether or not they have to actually get there. I've talked to several Fed officials about this. So I don't know. I think the game is on the outlying months and how much you bring forward.